Welcome, everybody. Appreciate the patience. We're all here and getting started now. We've got the Spartan team here with us today with their latest fund to share. I will share my screen real quick just to call out our quick little disclaimer. We do like to point out, these deals are not vetted by Left Field or TribeVest for that matter. So do your own due diligence and figure out if this is a deal that you want to get involved in, but we like to splash this up. So you can read through it at your own time if you wish. I will stop sharing, and Eric, I'll kick it over to you. You can walk through the Open Tribe details.
All right. So for this investment, we're opening a TribeVest Open Tribe. What is an Open Tribe? It is a professionally managed, completely turnkey, active single investment vehicle. So we're at TribeVest will handle all the management for the entire process for the company, the soft commits, the distillation, the collections, everything. It's TribeVest Open Tribe is passive investing simplified. So what are the benefits to you as an investor to use an Open Tribe? First, it's lower minimums. This minimum, I'll have to look, I'll post it. It's a lower minimum to get into the deal. Access to better deal terms. So we're pooling capital to get access to better terms in the PPM. Access to more exclusive deals. Some deals only take a single check. So we can get access to that. With TribeVest's platform, you have online visibility to all your investments and the bank accounts and the equity tables, and you can see it all clear and transparent. The safety and security of a professionally managed LLC or single purpose vehicle. We're investing as a community. If we find something as a community we like, we can do it together. And then again, simplified passive investing. Sorry. Keep going. So I want to just quickly go through how it works. We're opening a soft commit for this deal with Spartan. I'll post the link in my contact info in the chat in just a minute. But first thing we'll do is we're going to collect soft commits for a week. If we hit the minimum threshold, which is $100,000 in total commitments, we'll form the tribe and the LLC. You'll go through an onboarding process, collecting all the funds. If it requires accreditation, we handle the accreditation piece, and then we do all the communication and legal documents with the operator. And then we invest the money, effectively wiring it to investment, so investing the money. And then from there, the next step is there's ongoing management that goes with this. So as communications are coming out from Spartan, we'll send them out directly to you. There'll be quarterly distributions whenever they're available. If there's a distribution available, you'll get a distribution. We'll keep the LLC compliant. We're going to do the yearly K1 services. So everyone will get that joins this tribe will get a single K1. This tribe only invests in this single investment. There are no other investments that it'll do. It's just designed for this. And then when the investment is over, it's run its course, we'll dissolve all the services and take it all down from there. So what's it cost to get everything set up? It's $150 per member. That does include your first year taxes. And then ongoing, it's $100 per member per year. So the initial setup, there's formation, registered agent, there's a lot of work we do, but we're also including the taxes next year. So your first money, really your next $100 will be due in late 24. Late 24, because we're handling the 23 taxes. Sorry, I was trying to do math in my head. But anyway, and then if we have cash flow to cover it, that'll be up to the business, up to a vote that we could potentially cover the fees if there are available cash from distribution. So no additional money required until late 24, early 25. So if you're interested, there's a QR code. We have a landing page where we have all the open tribes listed that are available. You can bookmark that. You can also subscribe to the email, and we're sending out, I think it's bi-weekly emails just with what's going on, the new tribes that are open and other opportunities. And then look for the email coming out with this webinar, or for communications, look for the Open Tribe link from Left Field Investors. That's it, Chad. Thank you.
Awesome. Thanks for that, Eric.
You bet.
Appreciate that. And with that, we'll turn it over to Ed Osborne from the Spartan team. One quick thing just to note, if you have any questions along the way, feel free to type them in the Q&A and we'll cover those at the end, probably, if that works, Ed.
Works for me.
Perfect. So all yours.
All right, let me get in presentation mode here. Can you see my screen?
Yep, it is up and going.
All right. Excited to be talking about the Spartan Storage Fund three funds this year with Left Field Investors. Have some very good investors we met last year with LFI and previous years. So very excited to be talking to you. So thank you very much, Chad. All right, so we're talking about Spartan's 23 storage funds. A little bit about Spartan to start with. Today, Spartan, according to Inc. 500, is the fourth fastest growing private real estate company in the country. So we're proud of that. 126th fastest growing private company in the country. And we are currently the number 40 operator of storage in the US. So a lot of work in very few years to get to these numbers. We're a vertically integrated company, soup to nuts, so to speak. So everything from acquisitions to raising the capital. We have our own construction company, our own property management company. So basically everybody from the person that looks at an acquisition to the start of it to the property management are all Spartan employees. Here's just a quick look at our current holdings. We own 62 properties. You'll notice heavily focused on Texas and the Southeast. Really what drives storage is population growth and income growth, and both of those places have it in spades. You can go to our website and download our 700-point due diligence checklist. This is a checklist that we run every acquisition through, whether it's bare land or a up and running storage facility, so we don't have any surprises when we make that acquisition. You can download this at our website, use it for your own properties, your own projects. It's just a lot of years of learning put into a spreadsheet that if you can check it off, you're probably in a pretty good spot. Why storage? So we got into storage because I think everybody has heard storage is a relatively recession-proof asset. And if you take a look at this chart, that top line, that gold line is occupancies. And then you look at these downturns. So that's Black Monday in '87. That's the dot-com bust. I think everybody remembers where they were in '08 and most certainly in the last few years. What you look at this chart, you see is a lot of disruption, but you take a look at that top line, disruption doesn't seem to, it does not really affect occupancy rates in self-storage really at all. So the reason we got into it is it's a good business when it's good, as you can see, and it's a really good business when the times are not so good. Because really what drives storage is life events. When it's good, you're getting married, you're having kids, you're needing extra space. When it's bad, you're the economy's gone to heck, you have to downsize, you lost your job, you're moving cross country, you got divorced, whatever it is, that's what drives storage. So life events drive storage, which leads to good times or bad occupancy rates maintaining. Another way to look at that is over the COVID years from 2020 to 2022. These the REITs are publicly traded companies on stock exchanges, so you can take a look at what their returns were. And the far right of the chart, office, lodging, all of those things, when everything was closed down, pretty easy to see what those returns would be. But if you go to the left, self-storage REITs recorded an 82% return to their shareholders. So just absolutely dominated the real estate REIT market during those COVID years. Again, disruption. We're in a pretty good spot when disruption happens from a self-storage standpoint.
Hey, Ed, sorry to step in.
Yeah.
The screen share that we're getting includes the next preview slide too and some notes. Is there any way to work that around so we can get a bigger image of the full screen shot of it?
Oh, I'm sorry. It's
extending
my screen.
Yeah. Maybe even if it's not in presentation mode, maybe it would pop up better.
That better?
Yeah, that's a little bigger. That works out better.
Okay. All right.
Thank you. Sorry about that.
You bet. Yeah, I'm sorry about that. It's stretching my screen here. New setup.
I get it. Technology, it's our friend today.
Technology, that's right. So again, the REITs and self-storage market absolutely dominated there. So the smart money's been moving into the self-storage arena for a while. So Public Storage is the largest publicly traded REIT in
Hey, Ed,
industry.
sorry to bug you again. The screen we're getting now, it only it has your like Spartan fun splash screen, like your first slide. So we're not caught up with you on your presentation. We're seeing the first slide still.
Goodness, let me.
Sorry, we will get this. I have faith in us.
I'm sorry.
No, I don't know.
How about if I just take it out of presentation mode? Does
Yeah,
that work?
that might work better.
All right, but
Yeah, I think that shows up good enough.
all right. All of my
There we
animations
go.
won't work.
No,
but...
yeah, all the fancy stuff will go away now, unfortunately. But
all right, sorry
yeah,
about
I
that.
think that's a little better. No, thank you for that.
So the next screen was talking about all of the big money moving in, the REITs moving in. Bill Gates moved in, Blackstone moved in with a $3 billion acquisition. Bill Gates had a $3 billion acquisition. So the money's been moving into the storage space for a long time. During that time, in 2021, Spartan acquired about $200 million worth of, and actually this is in November. In December, we acquired another 50 million. So it was about 250 million in storage in 2021. Backed that up last year with another 65 million in storage. So let's move on to what we're doing this year. 3 funds, a debt fund, an income fund, and a growth fund. So if you, hopefully there's some people on the call that invested in the Spartan Storage Fund 1. Our income fund is essentially the same thing. It's value add properties in secondary and tertiary markets around the country. These are the properties we bought last year. And actually, if you are in the fund, we are closing one more property in Georgia that will be closing this month that will be going into the fund as well. So secondary, tertiary market, value add facilities that we're buying. This is where we bought them. Again, heavily focused on that Southeast. Everybody in the Northeast is migrating south, bringing their money with them. And that creates the population growth and the economies of scale that we're able to create with these properties, rolling them into our existing portfolios, being able to share maintenance and marketing and employees and district managers and stuff like that, really allows us to lower our overhead on these properties. So the income fund is a cash flowing fund monthly with upside when we sell that has depreciation with it. Target returns this year are 14 to 20% annualized returns over the whole 5-year hold period, with a 4 to 8% monthly cash flow and 1.7 to 2.2 times equity multiple on the backside. So again, this is just looks at what kind of the progression of your investment from year 1 to year 5. We buy the property, we do the initial improvements, we implement the business plan, start raising the rates, all of the good stuff that equals increasing monthly revenue or monthly distributions year over year. So this is what we're doing this year, a little bit different than last year. We're going to have 3 share classes. Last year we had 2. A share is 50 to $1 million, then $1 million to $3 million, and $3 million above. So the A share is a 7% preferred return. B and C are 8%, and then 70-30 after that. I'm sorry, and then 14, 15, and 16% hurdles, going to a 50-50. 55-45 and 60% split. But what is fun this year is if you invest in the first 45 days, we'll immediately bump you a share. So if you have invest in an A share and within the first 45, you get the benefit of a B share. As you can see down at the bottom, that's a 5.5% return over an A share. And what we'll offer to the infielders is if you can hit that B share minimum, as a group, will bump you to a C share. So if you take a look at that, that is a 9% return over an A share with some pretty good backside opportunity on that 60-40 split. Then, and I saw a question, what's the difference between investing with us versus investing in a REIT? One of the big ones is depreciation. When you invest in a REIT, you are investing in the stock market. It is not an equity investment. You're not getting the benefits of depreciation. So as you take a look at the chart here, we're expecting 30% expected tax loss. So on a $100,000 investment, $30,000. You saw earlier the expected cash flows are around $32,000 over the course of the investment. So you can use that first year depreciation and basically wipe out your entire tax bill over the hold period. And that's not including the depreciation that you would get in the second, third, and fourth year. So how do we add value to these properties? And if you take a look at some, and yes, that is a tree growing out of a unit. These are not even extreme pictures whatsoever. So again, talking about being a vertically integrated company. We own the construction company. We can jump in, we get in there quick. These are very, very easy repairs that if you take care of them yourself, get the doors working, get them cleaned out, do some tuck pointing, get the trees out of the units, all of that kind of fun stuff. There's a lot of value to add here. And mom and pops, a lot of the people that we buy from, they're really concerned about filling these things up, and they're just operating a business. Once they're filled up, put it on cruise control and forget it. So they're not operating it like a REIT quality business. So these are very, very simple things to do, but they're things that a mom and pop generally isn't going to do because they don't need to. Just some more pictures. I mean, granted, we obviously get some pretty cool cars when we take these over. No sense. You fix that, soup that, looks like a Firebird, right? You can soup that up. And, but I mean, this is just kind of the mom and pop, just how they operate. They don't have to do a lot to get their businesses filled up. Here's a great example of our Devonshire facility. A very, very little bit of work creates curb appeal. And that's really what drives self-storage. Is you drive past it, you see it, and you move on it. I don't know if you want to move into Devonshire, but free up storage certainly looks much more appealing than it was prior. Just, paint the fence, monument sign, and obviously we fixed that tree up there in the back. That helps. Just some more examples of just some very initial improvements that we're able to do that help the curb appeal. These are actual pictures of the offices when we buy them. I think that one on the right had 14 cats in it when we took it over. But when you walk into these facilities and you walk into the office, I mean, that does not portray to be a very professional business, right? So it doesn't take a lot to turn that into this. And I mean, that is, clean, very, very nice, easy on the eyes, looks like a professionally run business for a professionally run or property management company, which we are. Next thing we do is we got to make sure it's safe and secure, fix the gates, fix the fences, fix the locks on everything. A lot of doors on a lot of these older ones are cockeyed and not working well. So just some very, very minor improvements that don't cost a lot of money, but add peace of mind to the renters. We found getting involved in the community is really important in the storage business. Up there on the upper right-hand corner, that's we did a trail restoration in one of the communities helping out. We invite the Chamber of Commerce every time we have a ribbon cutting. The mayor of Tyler, Texas came to one of our parties at one of our facilities. So we invite the community into our facilities, and we help especially in these smaller tertiary markets, people know people and they talk and all of that. So the more ingrained and involved you are in the communities, the more you lease up, basically. Another value add strategy is that on the left-hand corner, that's a van that we own at a few of our facilities. You lease a unit, we'll let you use our van for a couple of hours so you can move your own stuff in. We have U-Hauls at a lot of our facilities, and we don't make money off of this. It's just really a convenience. If you're comparing two facilities and you don't have to drive across town to get a U-Haul, you're probably going to go with our facility, along with the sundry items down there on the left, boxes, tape, all of that kind of stuff. Again, we don't, they're not drivers of revenue necessarily. We do make a little bit of money off them, but it's more of a convenience. And that convenience leads to, converting people walking in the door. One thing we've started doing here recently is something called Storage Defender. It's basically a little box that goes in the units that has motion detectors. It'll detect if the door opens. It has heat sensors if it's a climate controlled facility. If it goes above or below the temperature that you have it set at, you'll get a text message saying, hey, your door just opened. Did you do it? If you text back no, the next call is to the police that you didn't authorize somebody to be in there. So it's a little upcharge that we can, and sometimes we throw them in just as get them in, and people seem to like it. The next thing that is really just kind of the secret weapon in our business is insurance. So as a value add strategy, when we buy a facility, we require everybody in that facility to have insurance. So that insurance that we can provide is $13 or $22 a month. You can also provide your own homeowner's insurance policy. You can get your own rider, whatever you want to do. But generally speaking, we've got a pretty good conversion to ours, and we keep the revenue 70, back to the insurance company 30. So that goes straight to the bottom line, back to the investors, increases the NOI. So if an average facility is 550 units and we get 60 people to take ours at the cheapest rate of $13, that's $36,000 a year of NOI. And if you look at it from a cap rate perspective, that increases the value of the property by about $750,000 for doing essentially nothing. Very, very, it's the mom and pops do not require, generally speaking, insurance. So it's a real easy value add strategy that we have. Next thing we do is we're buying places below market. So or below market rents. We get the rent rolls of the property that we're looking at, throw them on a spreadsheet, and then we go around town. We knock on the doors of existing facilities in the area. We call them, we cold call them, private shop them, find out what they're renting 10 by 10s for, 10 by 20s for, throw that on the spreadsheet and see where we're at. What value can we bring to this? So if, real easy example is, if our rent rolls are at 30 and the market's at 60, we'll raise the rent to 50 and not even go all the way. And if my animation worked, you'd see this guy would pop up and he'd go, is this what I want to do on a Saturday morning? Probably not. But if it is, and he moves out, the next person that moves in is paying $60. So we made $10 more than we would have made off of him just on a monthly basis. So moving out when we raise the rates we actually underwrite about 20% move outs, and we never quite get that 20% move out, but the more move outs, ultimately the better, just because the next people moving in are going to be paying quite a bit more. And then we bring our own property management team. So when we're buying from kind of the unsophisticated owner, they don't have the technology, they can't book online, they don't have the automation. We do a lot of training, bring REIT quality management systems in, and a 24-hour call center. So really just ups the game on convenience for our customers. So that was the income fund. Again, if you're in the Spartan Storage Fund 1, very, very similar. The only thing is they're a little better splits this year. I'm really excited about the growth fund because this is growth is ground up development. It's facilities that have a ton of potential that they haven't got there. It could be a property that we buy that's got 20,000 square feet of storage, but there's an opportunity to build another 50 or 60,000 square feet of storage. So that's going to be a cash drag for the first few years, but there's a huge upside. So, we buy a 50,000 foot facility, build 50,000 foot, we're selling a 100,000 foot facility, which, obviously on the backside, the NOI that additional 50,000 is going to compress that cap rate and, have some great backside potential. And then just creative opportunities, something that doesn't fit in a cash flowing fund, we can throw into this fund and nurture it and make money on the backside. It's gotten difficult over the last couple of years when you had just had the one fund and it had to hit certain benchmarks and it had to hit, we got to cash flow 4 or 5% a month. we had to walk away from a lot of deals. So this year it allows us to take the right deal, put it in the right fund with the right investor that's what they're looking for. So first fund was cash flow. This fund is just high upside. So the target returns, a little bit better, 19 to 26% on the annualized return, 1.9 to 2.3 equity multiple, 15 to 20% IRR, and again that same 5% hold or 5-year hold period. These are pretty conservative, I think. And we'll look at some things here a little later that'll show you that. But here are the returns, and again that same first 45-day bump. And the A, B, and C share have the same investment amounts. You notice it says liquidity preference instead of preferred return. So we don't anticipate this fund having any cash flow. So the first 12, 14, or 16% of the income that we make goes to the investor first, and then we split in that C share. If you guys can get to that million mark of the B share and get bumped to a C share, that's far and away the best split we've ever had. 70-30 split to the investor after the 16% equity preference. So pretty excited about this fund, and some really great splits we think for the investors. And again, at the bottom, kind of the same look at the different share returns. So, a 15% benefit over an A share if you get to the C share, 8% on the B share. So we're very excited about this. Oops. And again, another way to look at the depreciation, we're looking at $30,000. So on the income fund, if we buy raw dirt, we can't take depreciation on the raw dirt, but if we buy an existing facility, we can take that depreciation. So the depreciation may hit in different years, and as soon as something we build goes into service, then you'll get the full depreciation on that, probably in year 2 or year 3, whenever we're able to take it. So how do you create value in development? First is you acquire land, you entitle it, you get it ready to roll, and you could sell it at that point. And I've got an example. Hopefully I can figure out how to play the video here of this next example, since I'm not in presentation mode. But you acquire the land, you entitle it. Sometimes that could be very, very simple. Sometimes that could take years. But that property entitled is worth a lot more than it was as bare land. So you could sell it there, or you move on to the next phase, which is the construction phase. Generally going to take us about a year to build 50, 60, 70,000 square feet. Once we get the certificate of occupancy, that's the final inspection. They say you're good to go. You're ready to start business. We could sell it at that point and get about 100% project level returns there. That's just somebody that wants to come in, do the hard work and marketing of leasing it up. But they're getting a little bit of a discount at that point if they buy it there. Where we're at in the project I'm going to show you is in the lease up phase. And that means, it takes 2 years to 3 years to get a large facility completely full. So during lease up, say we get to 50% lease up, somebody may come in and say, hey, we want to buy it at this point. We're like, fantastic, we'll sell it to you. That's great. And then let them take it to the end, or we take it to completely stabilized, call that, 90% occupancy, 85% occupancy, somewhere in there, and looking at about a 200%. And these are just kind of down the middle returns. I can show you some returns that we've had in some of these case studies I'm going to show you, but 200% project level returns once we get it stabilized. So there's a lot of exit ramps that we have. If at any point, if somebody wants it bad enough and are willing to sell or willing to make us an offer we can't refuse, as they say, we've got 4 or 5 different points along the time that we can do it. I will try to play this video. Let me know if this works on your end.
Sure.
So if you can see this is a piece of property we bought just outside of Washington, or just outside of Seattle. Terrible piece of dirt. Took us 2 years to entitle it, another 1.5 years to build it, just because the dirt was so bad that we had wetlands, we had Corps of Engineers issues, we had tribal issues, just everything you can think of. We had just issues, but we stuck to our guns. We got it entitled. Took us 2 years to do it. I'll jump back out of that. Took us 2 years to get that entitled. Come on, here we go. So let's jump into the case study. So 2 years worth of work. We bought that for about $1.2 million. It cost us about $1 million to get it entitled over the course of that 2 years. We got an offer for $4.3 million at that point. So that's 172% project level returns just to sell them an entitled piece of dirt. We didn't want to sell it at that point in time. We said, we've got a construction company, let's build it. So we built it, took us a year to build it. Year 4, we got our certificate of occupancy. So, I mean, that's 4-year hold there just to get the property built. We could sell it at that point for about 113. And again, we're at about $14 million. We were at $2 million before. Now we're at $14 million. So our project level returns are about 113% if we were to sell it there. We did get an offer and we decided not to sell it at that point in time. We're currently right now in the lease up phase, about year 4.5 right now. We're at about 35% occupancy. Get that up to 50. We could sell it, call it 175% return on that. And then once we get it stabilized, year 6, we actually performed this at 8 years. So we're about 2 years ahead of schedule from where we were, but we could sell it at about 350% project level returns. We only know that because we just got a broker's letter valuation at 28.5 million, and we're 14 million into it. So pretty happy with that. Here's another one. This one has a video as well. Let me see if I can get that.
The video didn't come through to us last time, unfortunately.
Oh, okay.
No, now it's coming through. This is
okay. So this is Sandy, Oregon. We bought this property from a guy who had been trying to develop this site for 5 years. And he, according to the building officials down in Sandy, Oregon, was the most hated man in Sandy, Oregon. So they were not particularly gracious to him, as I don't think he was particularly gracious to them. But he approached us, asked us if we wanted to buy that particular piece of property. We said yes. And it was basically, we bought it. All we had to do was pay the permit fees. And if you saw in the picture, he had a Connex sitting there and they'd asked him to move it for 2 years and he hadn't moved it. So we said, what do we need to do to get permits? They said, move the Connex and pay the fees. We moved the Connex, paid the fees, and got permits the next day. So we skipped year 1 and we just built it. We got certificate of occupancy last August, could have sold it there. And you can see going through that, what the project level returns would be. So another buy. It's just like the last one where we could have sold it when we entitled it. That's what we did on this one. So that's where we create the value there. This is just another example, but, and I won't play the video on this one because I don't think it's working very well. This was a mobile home community, and this is just showing another way. So we sold this one at certificate of occupancy and returned 65% IRR back to our investors in 22 months. So we bought the property, kind of a joint venture. They were having problems. They needed our expertise to get it over the finish line on the entitlement side. So we entitled it, we built it, and we sold it at certificate of occupancy at 22 months, returned 154%. The IRR was 64%. So that's because it was in 22 months. So the whole point of this, there's just a ton of ways to get value out of the properties at different points. So during the course of this fund, we can buy land, entitle it, sell it, build it, buy, there's just a million opportunities. That was another one. So what that video was an existing facility where we built another 40,000 square feet. So obviously you can buy a facility, build on it. It's going to drag, but that's growth, that's value on the backside of it. And then construction, or our Spartan Construction Management, that's the president, all in-house, everybody. Aaron came from a very, very large industrial contractor, and everybody that he's got working for him for the most part, came from the big construction businesses around the country. And we're able to, it's not tough to build self-storage facilities, especially when you get guys that are used to building bridges and stuff like that. So very, very, very good construction team there. So on the value add side on the growth fund, we're good at entitling land. We're very good at it. It's hard. It's you're banging your head against, look down there on the left. I mean, you got to read every one of those pieces of paper, but we're good at it, and we've proven that we're good at it. So that's really where we can bring some value. So that's the growth fund. Again, that's what I'm excited about. Actually excited about all of them. But then we're going to offer a debt fund as well. Going to raise $60 million of debt. It's either going to pay 8 or 9%, which I'll get in here in just a second, and have a redemption option. So we've got an A share, which pays 8% on your $50,000 minimum. And that has a 90-day lockup. So after 90 days, you can call your money. As soon as we get the PPMs loaded up, there's some fine print there. Obviously, I think we're going to have 2 redemption periods per year, but you can call your money back after 90 days for an 8% return. For a 9% return, it's a 2-year lockup, and then you can call it back. You can redeem it after 2 years. All of these can stay as long as 5 years if you want, but both of them have redemptions either after 90 days or after 2 years. So that's the difference in the share prices. Got a track record. We've done a lot of private debt. Generally speaking, it's always been on an individual property where we had to use that money at the property level, which is why we're moving to a fund this year that just gives us more options, so to speak, that we can use them across any of our properties. But we do have got full cycle on quite a few debt raises. Very easy to do. Sign a subscription agreement. We'll get you a promissory note. You hand us the money and we start paying you. Nothing too crazy there. All right. And then just kind of where we invest, what we look for, touched on this a little bit. We're outside of downtown, call it secondary, tertiary markets. There's much less competition from the REITs there. I mean, those guys are writing, as you saw above, 10-figure checks. We don't have the 10 figures to spend. So we, go outside and really try to aggregate those smaller mom and pops into large portfolios. Where we invest where people are moving to, we invest where we have other properties for those economies of scale. Talked about that a little bit earlier. If we can share marketing budgets, we can share maintenance budgets. All of that increases the NOI of the portfolios, which in turn increases the value back to the investor. So again, we're looking for job growth. We don't invest in the Northeast. We invest in the Southeast because everybody in the Northeast is going south. So we're looking for that positive migration. We're looking for the demand in the storage, and where you have net migration and you have income growth, that means you can push the rents and then economies of scale. So let's get to exit strategies. This is what we're all here for, right? We buy it, we hold it, we sell it, and we make a bunch of money. So optionality is what we are here for. So we own 60 properties currently. By the end of the year, we'll probably own 100 properties. We can sell 10 of them. We could sell the entire thing to a REIT. They knock on our door every day trying to buy every piece of property that we have, or we can sell them individually. The couple of properties that we're going to sell this year are just one-offs here and there. They just may not fit into our, we talked about economies of scale. If they're a little too far out, came in a portfolio we bought a couple of years ago, we can spin them out. We just, talking about money in the space, we bought a property 2 years ago at a 5 cap and we're selling at a 3.8 cap. So for anybody that means anything to, that's good. And again, just going to the money is still here. Prime Group just closed last month, the $2.5 billion fund that's all for self-storage. So that's $2.5 billion more that's going to be floating into this, into our, where we are. So that's great on one side, makes it a little more difficult on the buy side. But again, that's why we stay out of downtown. These guys aren't going to buy anything but, the downtown glass palaces, as we call them. Public storage, again, the largest REIT just made an $11 billion unsolicited offer for the number 6. One trying to take out 6 for a 19% premium, and number 6 told number 1 to pound sand because 19% wasn't enough. Again, that's really good for what we own, and for our investors as well. So we are the 40th largest operator of self-storage, but as you'll see here, those guys on the right are big. So number 40, there's a long ways to go to number 1. So we're kind of in the middle. We're kind of aggregating all the mom and pops, potentially for a big REIT sale on the backside. But mom and pops know what they got. So they're chasing us all over the place as well. You own one facility and you make 50 grand a month. Why not own 2 facilities and make 100 grand a month? So of the stuff we're selling, one of them we're selling right now is to somebody that just owns another facility down the street. So tons of options on the backside to be able to sell. So what you can expect from Spartan when you invest with us, monthly communication and reporting. We, a blurb every month about how the property's doing, the monthly charts, the monthly P&Ls, and then we do a full financial every quarter, but you get this every monthly as well. We do a quarterly webinar and a quarterly wrap up of all of our properties. And that's it. That QR code will take you to some information, and I guess it's question time, Jen.
Awesome, great. Thank you for the presentation. Again, reminder, anybody has questions, drop them in the Q&A. It's like a couple are filtering in. The first one that was in there, Ed, you kind of called it out as you went through talking about the differences between you guys and the REITs. Any other points you wanted to call out? I know you highlighted depreciation, but any other factors that are worth? I didn't want to lose sight of that question, just in case there were some factors that are worth talking about.
Yeah, it's really, it's apples and oranges, really. It's just you are investing in a Spartan deal. You have an equity piece. You own a share of that property. When you're investing with a REIT, you are investing in the stock market. I mean, that's really the difference. Depreciation is obviously something you get as an equity owner, essentially, of property, which you don't get when you invest in the stock market. So that's really the difference. They operate self-storage, we operate self-storage, but it just depends on how you're able to get involved there.
Makes sense. Okay, the next one was, I watched the debt fund webinar yesterday, and it sounds like the debt fund is promissory notes signed by the principals and not a mortgage lien on the storage facilities themselves. Ryan mentioned on the webinar that the notes were secured by storage facilities. If it is not a mortgage lien, is it a UCC loan and the operating business, or really just a promissory note?
It's really a promissory note that is secured by the owner's interest in, they own about $200 million worth of storage. So it's a promissory note against what they own.
Gotcha. Then next, with more and more actors moving into storage development, are there any signs of over occupancy?
Yeah, it's funny. There are 60,000 storage facilities in the United States. That's more than every fast food restaurant there is. McDonald's, Burger King, that's more than all of those combined. In the last 10 years, there's been more storage built than existed before 10 years ago. And in the last 10 years, occupancy's gone up 10%. So there's still a huge demand out there. And I mean, every time I drive around, I'm like, my gosh, there's storage everywhere. But the actuality is no, there is not. I mean, there are places that is overbuilt for sure. Yeah. But those are not places that we're going to buy.
Still places to fish as well. Huh?
Yeah, absolutely.
And then we had a question. How do we get a copy of the slides compared to the slides in the webinar link? I don't know if this was a different presentation or not, or if you can send a copy of this one, we can share it out too. So
absolutely. And you'll be able to see the videos.
Yeah, there you go. We always do a follow-up email, so we'll make sure that it gets attached to that follow-up email.
Yeah, not a problem at all. I'll send it out.
And then they're also asking, could you go back in the slides and show the target returns for the income fund?
Yes. Way back. There we go.
Oh, yeah. There they are. And what are the minimums on these funds? On the
50,000.
50.
Yeah.
And you're investing, you're picking one or the other, or you can do a combination of both, or all three, I guess, technically.
Yeah, yeah, and it really depends on where you're at in your investment. I think most of the people I've talked to are going to do income and debt or growth and debt. One way you could, if you're in the growth fund and if we're just buying raw dirt, you're not going to get that depreciation. You could offset that with an investment in the debt fund as well. So yeah, the majority of people I'm talking to are probably going to do 2 of the 3, but because you can get in growth and get that big upside, but go into debt and get that monthly guaranteed income.
Yep. Nope. That makes sense. A good way to diversify right in Spartan funds by itself.
Yeah, absolutely.
Any other questions? That's all we've got out there right now. But it looks like that's dried up. So if that's it, again, people can reach out to Ed or the team if they do have any other questions. Feel free to do that as well. And Ed, we appreciate you joining us today. Thanks for the time.
Yeah, thank you, Jen. I enjoyed talking to you and all the infielders.
Absolutely. Thanks, Ed. Thanks to everybody that joined too.
Right.
Have a good one, Ed.